I feel like there are some episodes of this where there's some episodes of our podcast where I think like, okay, this is a Tracy podcast. I'm probably mostly just going to sit back and listen. And anytime I feel like we're going to have a conversation that involves the term delta hedging, which I'm still like kind of like haven't totally like locked down solid on what that means. I'm like, okay, this is like a Tracy episode.
Okay, first of all, that's very sweet of you to say. Second of all, I just told you that I lost all my notes for this episode. So now I feel like the stakes are very high and, I might not do as good a job as you expect. But yeah, we're going to be diving into delta hedging. But the weird thing is that delta hedging has kind of exploded into the public consciousness for I think the first time in a while, or at least everyone in the market is talking about it because we have this big drama in options.
Yeah, that's exactly right. So basically, I mean, one of the most surprising things in this crisis period, and we've talked about this a few times, is the degree to which retail traders have really aggressively jumped into this market, timing the market really well, jumping in right at the bottom. We sort of know about the mania, but what's interesting too is sort of the option strategies, not just sort of like buying Tesla or buying Amazon or buying Netflix, but actually like trading aggressively with options. And the use of options has all kinds of interesting sort of like market structure ramifications.
Yeah, absolutely. And one of the big developments that we've discussed on the podcast is the rise of Robinhood and,
Yeah.
Reddit forums like Wall Street Bets. And instead of just buying stocks and profiting as the shares go up, a lot of people are undertaking equity derivative strategies, call options to get leverage on their trades. And some of them seem to be making big money. But the major question for markets right now is whether or not all that options activity, that rising options activity, actually has an impact on the underlying stock.
Yes.
So that's the big question. There's one other bit of drama that we haven't mentioned yet, and that is SoftBank. So, SoftBank is a Japanese conglomerate, a big tech investor, and it emerged relatively recently that they had been buying call options as well, although I think there are varying reports about what exactly they're doing. Some people are describing them as the whale in the options market, the implication being that they're moving prices in some way. Again, there's a lot of debate about how much influence they actually have. We're going to be getting into all of that on this episode.
Right. Anytime SoftBank is involved with something, there's an added level of drama because people love SoftBank drama. They love the whole WeWork thing. So it's like, oh, SoftBank is doing the same trade, buying a bunch of tech stocks as a bunch of people on Robinhood. It's
Yeah.
just a super juicy story. And
SoftBank
so we're
plus
going to sort
Robinhood
it all out.
plus Wall Street Bets. It's kind of the perfect combo.
Perfect Twitter fodder. So we're going to break down what is actually going on, and we are our guest today is our go-to for all things volatility, all things option trading. We've had him on in a couple of times in the past. He is Ben Eifert. He is the CIO at QVR Advisors, and he has a gift for explaining this stuff in plain English. So Ben, thank you very much for joining us. What is delta hedging again?
Hey Joe, how are you guys? Thanks for having me on. I'm excited.
No, but seriously, what is it again? Delta hedging? I always forget.
Absolutely. So think of it this way, right? So, options are simple tools that investors of different kinds use to hedge their portfolios or to speculate in different ways. A call option, for example, is just a really simple instrument that gives the owner of that option, the right but not the obligation to buy a stock in the future at some predetermined price, right? So a retail investor that thinks Tesla's going up, could buy the next Friday's 2000 strike Tesla call, and if Tesla goes up to 2200, they're going to get to buy Tesla at 2000, and it's going to be worth 2200 at that point, and they might have only had to pay $25 or $30 for that. So it just gives them a very simple way of expressing a directional view with limited loss. Now, the thing to keep in mind is the way that this marketplace works. If that retail investor goes out and buys that Tesla call option, they're buying it from a market maker. And maybe that market maker holds on to that position. Maybe they flip out of it to a volatility arbitrage hedge fund. But at the end of the day, the other side of that option position, lives with a market participant that does not have a directional view on the stock, right? So the retail investor isn't sort of somehow magically pairing off with some, in every case, with some other retail investor that just has the exact opposite view and wants to sell that call, right? When the market maker sells that call option to the retail investor, that call option is going to have some sensitivity to the price of the stock. If it's out of the money, it might be, say, per contract, it might be 25% as sensitive, to the stock price. In other words, if 1,000 shares worth of Tesla trade, those call options might have, exposure worth 250 shares. The market maker is just going to hedge that exposure right away when they do the transaction, right? And so if a retail investor comes and buys a bullish option structure from a market maker, the market maker executes that trade and then buys some stock on the back of that to hedge out the directionality of that exposure. Right, the market maker's job is to buy on the bid and sell on the offer and manage down their inventory and take as little risk as possible. And so that's the delta hedging, just first order impact. And then the second thing to think about is that option delta or option exposure to the underlying stock price is itself dynamic, and it depends on where the stock price is relative to the strike. It depends on the time to maturity, especially for very short-term options. What will happen if, in that example we were talking about, if Tesla, rallies, 6 or 7% the next day, which in August it was doing, just on your average day, right? That exposure of that option might go from a 25 delta or 25% sensitivity to the stock price to 50%. And then as it gets closer to the strike, and what's going to happen then is the market maker who's holding the other side of that position is going to need to increase the size of their hedge. They're going to need to buy more Tesla stock to bring their hedge up to the 50%. And in doing so, that they'll end up having bought a vast multiple as much dollars of Tesla stock as that investor will have spent on the premium of the option. It could be, in this example, it could be 50 times as much. Right. So creating a very large amount of leverage for the end, retail investor that's doing this trade.
Right. I'm going to ask you that again in a year, the next time we have you on for a different topic, but that was fantastic.
So, I mean, on that note, this idea of the shorter term options, can you maybe describe or explain why they seem to have become very popular recently, and maybe give us some color on what people are actually doing in that market? Like, how big are the volumes at the moment, and why has everyone suddenly decided they want to trade short-term calls?
Sure, absolutely. So this has really been an evolving trend that the popularity of short-term options, this is a relatively new thing in markets. If you look back, 5 or 7 years ago, a short-term option would have been considered, say, a month, 1 month option. And there was a little S&P weeklies were starting to be listed. Most single names didn't have them. Very short-term options would have been considered, very path dependent, very risky. And you've just seen a steady, rapid growth in, their utilization, in the listing of those options on exchanges, in single names and index, and in the, relative fractions of volumes traded in those very short-term options. So, like in the S&P, for example, over the last 6 months, I think the more recent data is, some very large percentage of the daily volume in S&P options is in the, couple of days. Expiry is happening that day or the next day, like 30% or 40%. And that a similar pattern has emerged in, especially in tech companies, in mega cap tech companies. Now, in terms of, the data, what we see, right? So first of all, and all of this is, OCC, this is all exchange traded, data reported by the OCC, and, you can look at different individual transactions that happen. But so first of all, small trader buying of bullish call options so under 50 lot positions, those volumes had lived, let's say, previously a high rate on a trailing 1 month basis in any time in history up until 2020 would have been, let's say, $100 billion of notional trading across across single name options. It's reached $500 billion today. It's sort of went vertical, rocket ship blast off, starting actually in late 2019. So it preceded it. COVID really, I think, amplified this trend, but the trend started to take off before that. And I think it's partly associated with the elimination of brokerage commissions across the majority of the large retail platforms, and that, I think, you can have to give Robinhood some credit for pushing the market in that direction. And you can get into nuances of, are the trading costs for retail investors in options actually any lower? I mean, I think most people would argue they're not, right? It's just an optical thing about,
Right.
Oh, we're not charging you. But anyway, I think that's a separate discussion to some extent. You've seen this huge explosion. The chart just looks insane of, again, bullish call option buying by small investors. The other thing that you see, you can look at, again, it's really happening in call options, not in put options. So, small trader accounts are, trading somewhat more put options than they used to, but it's very modest. Whereas you see this just incredible parabolic growth on the call option side. The other thing to note is that, especially the last few months, flow is very heavily concentrated in mega cap tech. There have been a few different adventures that retail has had over the last 6 months. I mean, if you remember, in the wake of COVID, actually there were some large position taking in bankrupt companies and in cruise ships and airlines and some of the most distressed value names. But really, for the last 3 or 4 months, it's been very heavily a story about mega cap tech. So if you look at Facebook, Amazon, Apple, Netflix, Google, Microsoft, Tesla, rolling 1 month average daily single stock call volumes are around $200 billion a day. Which number would have been like $15 million,
Wow.
$20 million before in over a long history of time.
Adyen, the future-proof payments platform. Welcome all payments, be on the cutting edge of customer experiences, and grow your business with Adyen. Visit adyen.com/podcast to learn more. That's adyen.com/podcast.
So I'm looking, you sent over some charts, and as you mentioned, we sort of associate this mania with the COVID and sort of post-COVID era, but it really has been going on for a while, and you could see it really pick up in 2018, 2019. And it was the cover of that sort of infamous Business Week story that our departed colleague Luke Cowell wrote. Like, this was like the Wall Street bet strategy. Essentially, this idea, like, these little retail traders thought they sort of created a perpetual money machine, buy these call options, bullish, force the brokers to delta hedge, take positions with this idea that you could just sort of like snowball it into more money.
Yeah, no, that's right. I mean, that was some really great reporting that Luke did. It's an interesting community. I think the Reddit Wall Street Bets community obviously it's a microcosm of the broader retail investment community.
And
probably
Robinhood itself is also a microcosm, because we talk about Robinhood as kind of like Band-Aid or Kleenex, but it represents in the sort of lexicon what a lot of people are doing on a lot of different platforms.
Yeah, I think that's exactly right. And I think that's an important point. You'll hear a lot of people, who aren't necessarily that close to option markets, be sort of dismissive that retail activity could be large or could be impactful. And they say, look, Robinhood is not that big. But yeah, I think a lot of times when people are casually talking about the types of things that Robinhood is doing, you have to look at this kind of data across all of the major retail brokerages, and you see exactly the same pattern everywhere. Sort of these huge explosive growth at Schwab, at TD, at Interactive Brokers. It's not purely a Robinhood phenomenon. Robinhood's just the most colorful and makes the news the most, right? And to your point, the Reddit Wall Street Bets community, it's an odd subculture, right? Sort of an internet-like subculture that I think has a lot in common with the crypto community, and probably shares a lot of the same, people who were very active in crypto, like in 2017, right? it's a very, lewd talking crew on the Discord. You can go and, sit in the Discord and watch what these guys are talking about and what they're doing. And, to be clear, there are, influencers within that community that will say, all right, we're, this week, today we're buying the Tesla 2,500 calls for next Friday. And like, the volumes that we'll print are huge, right?
Yeah.
And it's not necessarily from any one account, but there's a couple million members in that chat, and if 10% of them go and buy a couple of contracts of Tesla, that volume is astronomical, right? And the market you better believe that the most sophisticated option players in the world and the Susquehannas and Citadel Securities are extremely focused on this flow and in predicting it in real time and all of the technology that you would associate with that, right? It's monster flow.
That's really interesting.
And to your point, these guys know about this effect.
Right.
It's really fascinating, right? But Joe kind of mentioned it, as Luke said. These guys will be the first ones to say, look, if we buy tons of short-dated weekly calls, here's how Gamma works. Here's how we put market makers into this negative convexity situation where if
I
stocks are
doubt
trending
that
higher, they're forced to buy. And,
100% that people understand that.
Benefits us. They get that.
You got to think that there must be some like regulators from the SEC also keeping an eye on Wall Street bets at the moment, although
In the Discord.
Yeah, exactly. But that's kind of a separate topic. So okay, here's the big question then. What is your sense of how much impact these traders are actually having on the overall market, and especially the mega cap tech stocks that have been in focus recently?
Yeah, absolutely. So I think the way you have to think about this as this kind of option positioning, what it does is it creates feedback mechanisms for trend amplification in markets, right? So it's not. I think the argument is not that necessarily even across the option trading community within retail that there's the amount of dollars of stock exposure that they're buying directly is like, so large that they're pushing everything up, right? But there's there's been a general move back into tech across both institutional and retail, right? It's certainly not limited to retail. And the nature of very heavy buying of short-term options by retail and big size, creates an amplification mechanism in the direction of a trend. And that could be up or down, right? Because the important thing about delta hedging and, to Joe's question, again, let's take that example of those Tesla call options that had been heavily bought and that the delta started out, at 25. And then as Tesla rallied, that delta went to 50% and to 75%, forcing the market maker on the other side to buy stock and buy stock and buy stock and amplifying that trend. What happens if then the next day, there's more sellers than buyers for whatever reason, right? Some large institutions are selling or whatever, right? And Tesla comes off 5 or 10%. These are very short-term options, right? And so suddenly the 75% delta of those options goes back to 50 and back to 25, and dealers have to sell out all of those hedges that they had, right? So the impact is not just a direct bullish impact, it's an impact that amplifies price action in either direction. Right. And I think you saw that at work this last week, right, where you had the rally kind of peter out. You saw very heavy institutional selling coming in on Wednesday, the last day of the rally, and then Thursday, the first day of the big sell-off, and then you saw the most wicked reversals in the most popular mega cap tech names that really were amplified throughout the day and into the close. So it's very hard, obviously, to give some kind of X percentage of the tech rally from this date to this date was somehow caused by retail option buying. I think that's an impossible sort of question. But what I think is very clear is there's strong near-term momentum trend effects that amplify that rally that come from retail positioning and options.
So let's get into the SoftBank angle of the story, because actually Bloomberg reported in early August that SoftBank planned to participate in public markets, particularly big tech companies. Then in early September, the FT had a story and they said SoftBank is the NASDAQ whale. So how much of a whale are they? And put into perspective how much they're doing versus all this retail money, and are they sort of leading the charge? Is it a drop in the bucket? Like, how do they fit in your view overall?
Sure. So, to your point, everybody likes to talk about SoftBank because, it's such a colorful company and, the personalities involved are very big in the WeWork story. Yeah, I think we have to put this in perspective, right? So first of all, I think Bloomberg reported in maybe it was August 10th or 11th, about some of the equity positions that SoftBank had been building in mega cap tech names. I think those were reported at around $10 billion order of magnitude, right? Buying $10 billion of stock in the biggest, most liquid mega cap tech companies in the world that have trillions of dollars of market cap over 2 months is zero. Full stop, right? Has no impact on anything. That's a tiny position from the perspective, not for a single institution, but a tiny from the perspective of volumes or market caps, right? No impact. A lot of the later activity that became interesting, right? So, option market makers and option market participants had been following, this kind of new, interesting, relatively large flow that started in early August in call spread buying for equity replacement purposes. And, just to give some example, and again, this is all, people kind of have strange ideas about like, how do you see this happening, or how do you know? Or this is all exchange traded securities. Large institutions, quote banks, execute trades. Everybody hears about it in real time. Not who the source is, right? Not that it's SoftBank, but and then you see the trades go up on the exchange. But these were large trades. So like on August 5th, you started to see, for example, Facebook, November 2020, 250, 275 call spread traded in, 35,000 lots, which is pretty big. And, Microsoft, the 220, 240 call spread went up 75,000 times, right? So everybody's going to talk about this and say, oh, that's interesting, what's going on? These trades were executed delta neutral, which means that the client was buying a call spread. At the time, this would have been a, 3-month or so call spread. And it was, or 3.5 months, and executed versus selling stock. So with no net directional impact on the market. Right? This was an equity replacement trade. So reducing a long equity position and replacing it with some options, and in particular with some call spreads. Now, first of all, this is a 3-month call spread trade, a couple of 3-month call spread trades I gave you an example of, right? So 3-month call spreads have, if you want to think about how much convexity or how much gamma that induces this kind of dynamic delta hedging impact that we were talking about, does a 3-month call spread trade have, compared to like a 1 week, a little bit upside call, for example? It would be, again, depending on the details, it could be 100 times less per dollar of notional, or it could be 200 times less, right? So a 3-month call spread is not a convex security. And as markets rally, it loses what little convexity that it has very quickly, right? This is just the objective of this kind of trade, from the end client's perspective, who already owns the stock. This is just a risk reduction trade, right? Where they're taking some stock off of the table, they're replacing it with an option structure that's maybe worth 3 or 4% of notional, where if the world falls apart and these stocks go down a ton, they only lose that 3 or 4% instead of losing, 20% or 30% on their stocks, right? So this is like very normal, very boring, except, decent sized, which is the only reason that options people were talking about them, transactions in the market, that don't have any of the types of impacts that we were talking about with respect to gamma. They do have some, they're longer term, they have some vega exposure or exposure to implied volatility. And those exposures got decent sized. And, there's some argument that the trades like this contributed to some of the market up but implied volatility up dynamics that we saw in late August. And you can argue about that, but I think there's absolutely no case that there would have been any meaningful impact on stock prices or on acceleration of stock price moves from this kind of flow. And later we learned that SoftBank was probably involved in some of this. There may have been some other copycat flow, but again, I think this was way overblown in terms of being impactful with respect to the NASDAQ.
That's why I love his take.
Before we get back to Odd Lots, I want to tell you about another podcast I think you'll like. Thrilling Tales of Modern Capitalism tells hidden stories about the brands that shape the way we live and work. Some are stories of intrigue, like how Bumblebee, Chicken of the Sea, and Starkist secretly conspired to fix the price of canned tuna, a move that has resulted in jail time for some and still threatens to upend a century-old industry. Other companies bring tales of unlikely success, like Crocs, who invented a shoe so ugly it became a fashion statement. and even graced fashion runways around the world. Triumph or failure, every company has a story, and those stories are more thrilling than you may have imagined. Subscribe to Thrilling Tales of Modern Capitalism from Slate and Apple Podcasts or wherever you listen.
Right now, small businesses have to be more efficient than ever, and that means every hire is critical. Indeed is here to help. Indeed.com is the #1 job site in the world because they get you the best people fast. You only pay what you need, can pause your account at any time, and there are no long-term contracts. Right now, Indeed is offering our listeners a free $75 credit to boost the visibility of your job post at Indeed.com/podcast. Indeed.com/podcast. Terms and conditions apply. Offer valid through September 30th.
Okay, so because they're trading 3-month call spreads, it doesn't have the same effect on markets as the short-term call trading does. I guess my question, and also you describe the call spread strategy as basically risk mitigation for their tech bets. But I guess, could I just ask, how weird is it that SoftBank, this big tech investor that normally does a sort of venture capital like business, how weird is it that they're just investing in the public markets like this? And who do you think is like in charge of their overall risk strategy on these type of trades?
I mean, it's certainly a bit unusual from their historical perspective, but I think SoftBank also is a bit of an enigma, and tends to do new, interesting things that surprise people and get people excited along a variety of dimensions. They sort of tried to play this down as sort of liquid treasury functions almost, right? Oh, we have a bunch of extra cash, and like, why not do something really simple with it? Normally you wouldn't think of buying tech stocks as a treasury function, but again, I think that it's relative. If you think of the risk that they take in private markets investing, investing $10 billion in some mega cap tech companies is obviously a whole lot less risky than putting $10 billion into a WeWork or something like that. So it's certainly a different style of thing. But is it like some totally crazy thing to do? I mean, I don't know.
I have a quick question. It's not quite related to this specific incident, but you mentioned the coordination that goes on in the Discord chats, all these small traders. How different is this in terms of its market impact from the days, say, 20 years ago or something, when a handful of macro fund managers like, the Soroses and Druckenmillers really would have been the big players in some of these markets, and the degree to which they could generate alpha by essentially, moving the market due to their weight?
I mean, that's a great question. It's obviously a very different flavor, kind of a few concentrated large investors, versus a huge herd of smaller ones that do effectively rely on, not just their own money to move markets, but kind of putting some of the conditions in place to amplify, trends and so forth. I mean, first, it's a lot more diversified, but, technology has really enabled large scale coordination, right? And you see then that's not just a finance phenomenon. I mean, that's a social media phenomenon. And, in a lot of ways, you have to think of Reddit Wall Street Bets as more of a product of kind of the internet and social media culture than of finance specifically, right? It's manifesting itself, now in trading and finance, but it's really this, technology-enabled rapid coordination function where an influencer can be followed by millions of people and can say, okay, let's do this, and actually get a lot of people to do things in real time. Whereas in the 90s, again, you did actually have quite a lot. The 90s really were the last heyday of retail option trading. It would have been, I think, still back in the 90s, you think of who were, what kinds of people were like really active trading options in their new E-Trade accounts and things like that, right? It was, lawyers and doctors and dentists and people who were kind of at the forefront of technology at the time and getting interested in markets and had some money to play with. Whereas I think, now when you look at the breadth of a community like Reddit Wall Street Bets, you have a huge variety of different folks, some with meaningful bankrolls and some with some with just a little bit of money. or some who started out with $10,000 and then now it was 200,000 and then it went to zero. And
Yeah.
the last week. I mean, one crazy thing about Wall Street Bets, it's a very gamified, aggressive risk-taking culture, right? And there's lots of posting of P&L screenshots, and the amount of like posting a screenshot of your $500,000 account that just went to zero last Friday, and then like laughing about that is pretty shocking.
This was going to be my next question, this gamification of trading idea. And you mentioned earlier the overlap of Bitcoin traders or cryptocurrency traders with Wall Street Bets. It does seem like the way they're trading and the things that they're investing in are just sort of much more exciting than traditional, buy and hold for the long-term investing. Is that going to be the new normal? Like, are we ever going to go back to a time where call options aren't as popular as they are now?
I think we probably will, right? Generally speaking, the way that I think you have to expect these kind of trends to end is with very large losses among the segment of people that are very heavily involved, right? This is extraordinarily risky speculation, where I think when a volatility and derivatives hedge fund thinks about how to quantify risk and how to measure how much risk you're taking in the portfolio, obviously we think about how risky a short-term option is, and the fact that if you're buying a 1 week upside call option on Tesla, if it just doesn't go up 10%, you're just going to lose all your money, and so you would size a variety of bets accordingly, right? Versus the gamified risk-taking culture you see in Reddit Wall Street Bets being, people say, well, I have $100,000 in my brokerage account. What's interesting to do today? Well, it's buying those Tesla calls, so I'll put that $100,000 into 1 week Tesla calls, right? Of course, what happens then is you lose all the money when kind of the huge upside move stops, right? So generally, over risk taking in complex instruments that are like this, I think the end game is a lot of people losing a lot of money and generally stopping doing this kind of thing. But can last for a while, because when you have these violent rallies that just keep going, people can buy lottery tickets over and over and over again and win 3 times out of 4 and keep playing.
Is there a way with the data, so, just going back to the original formulation of this, okay, aggressive call buying, and then the dealers have to sort of hedge their exposure, and so, then they have to buy stock. Is there a way to get a feel in the data for the sort of the community of dealers overall, the degree to which at any given moment, the degree and volume to which they'll have to jump in? So let's say, okay, I don't know, Tesla's up again today. So Tesla, I think, is up like 5% as we're speaking. Is there a way to know sort of in real time or roughly real time what that translates into in terms of forced buying or forced hedging, given the sort of constellation of outstanding options there are?
Joe, that's a very good question. You downplay, I don't know anything about this delta hedging stuff, and then you ask a very good question like that. So, I mean, so no is too strong of a word, but you can certainly attempt to model or estimate that dynamic, right? And you wouldn't be surprised that, folks like us spend a decent amount of time on that. But, think of it as, you have to observe all of the trades that happen in the marketplace. You have to have an educated way of modeling or guessing, is this a trade that was a customer purchase of an option from a dealer or dynamic hedger? With what probability do you think that that's true? Building up your kind of simulated portfolio that you think that dealers hold and volatility arbitrage managers hold versus end customers who aren't delta hedging. And you have to make, a variety of assumptions, and you have to, right, it's a modeled exercise, and you have a probability distribution around it, but then you can end up with, okay, here's, sort of how much here's how we think the gamma profile of dynamic hedgers, dealers and market makers and vol arbs in a particular stock is at a particular time, and how that changes as the underlying spot price moves. And, generally, I think before this huge retail euphoria of the last 6 months, a lot of that effort we would focus on, looking at the S&P 500, because actually gamma positioning of dealers in, the mega cap index was a huge and very important phenomenon, driven by institutional, largely call selling and put selling. But now, actually, much of the new trend is single name gamma positioning, driven again by these very short term retail flows.
So we talk a lot about the idea of the options traders having an impact on the market through delta hedging and the dynamics at the dealers themselves. Is there a scenario in which the dealers can have a sort of impact? Like, is there a scenario in which it can reverse? Can something happen at the dealers so that they become caught offside in the market, or they end up taking a position in the market which they hadn't intended to, and that affects the underlying, and then it sort of ruins Wall Street bets trades?
I think that, ultimately, there's a price for everything, right? Some of the early, I think there were examples of dealers and market makers, losing a material amount of money on some of the early growth in this, speculative retail flow in options, because typically as a dealer that has experience over the last 10 or 20 years, you see significant retail flow emerging in some stock, in the options on that stock. You view that as uninformed flow that's kind of paying the offer side, and you're really happy to take a big position, facing those folks earning a lot of bid offer, and not too worried that they sort of know something, right? And then what you saw, like in Tesla early, much earlier this year, right, was that flow coming and coming and coming in huge size and pushing the stock and huge realized volatility, and you actually saw some of the market makers lose a material amount of money on that. And I think, over time but what you saw is, first of all, implied volatility is moving much higher in those names, right? So, dealers charging a much higher price to facilitate that flow. And then, of a deployment of a variety of techniques and, hedging techniques to try to, better protect themselves. So, think of, accumulation of inventory in anticipation of future customer flow is a polite word, and leaning extra long the stock in anticipation of how things are moving. And, so at some point, you saw short-term Tesla options trading at 120 implied vol or 140 implied vol, right? So, the market re-equilibrates itself to the point where dealers and people who are short those options, can make money on the positions, because that's sort of how supply and demand works, right? So I think, are there dealers know what they're doing, and I think with these kind of products, it's not too likely that there's going to be like catastrophic losses at JP Morgan or something that are going to shut down realistic capacity of option market makers to support this.
I just have one more question. So, basic ideas, buying a call, it's inherently levered. You put up a little bit of money, you can either make a lot, but if you don't, it doesn't go in the money, you lose everything. And so it's a leveraged bet. And when the market, crashed in February and March, and I thought back to that Luke article, I was like, well, that was the top and they're all finished. All these leveraged long call buyers, they're gone. And then it's like, no, they like immediately, they didn't waste any time coming back. And that article did not turn out to be the top. But are you surprised that the speed and intensity of that washout didn't just sort of like obliterate that community, and that, are you surprised at how quickly they regrouped and got back in the game? Or were you surprised at the time?
Yeah, I mean, I was to some extent. I definitely, you would have typically thought if you have a big emergence of a lot of speculation, and then you have a huge market sell-off and people get burned, and then they kind of, take their ball and go home, right? I mean, I think part of it is, I think the size of that community has been expanding steadily, right? So it's, new entrants to the space. And that was amplified by COVID and lockdown, and the fact that all of a sudden you sent a ton of people home to work on their computers at home with nobody staring over their back, and they're bored, right? Anecdotally, and I think everybody has these anecdotes, right? But cousins and uncles and everybody in the back office at the banks that all are like opening Robinhood accounts, or again, Robinhood, using that term very broadly, opening brokerage accounts and asking about options trading and asking how to do things. And so I think that a lot of new participants have been brought in, and the other thing, some of these folks again are small scale guys who scrape together, or girls who scrape together 5 or 10 grand and tried to get into this stuff. But there's plenty of associates at law firms and investment banking analysts, and people who have money to burn and who have incomes and who aren't out spending them on drinks and bars in Manhattan. They got to find some other form of entertainment, and this is what they're doing, right? And so it is an impressive phenomenon. It's impressive how fast it resurged after March, and how it's accelerated to much bigger scale even since then.
Ben, that was great. I said in the beginning you have a knack or a gift for explaining complex stuff in clear English, and I think you really delivered. That was super helpful, and really appreciate you joining us.
Cool. Thanks, guys. A lot of fun, as always.
Thanks, Ben. Cheers.
Tracy.
Well, that was a fun episode. One of the major things, though, I highly, highly, highly doubt that Wall Street Bets understands any of that aspect of things. I think it's just a bunch of degenerate people that are trying to YOLO some stuff and get some clout. So there is no way that even the elites of that community have the following that they do, because there's no way they understand it. No way do people know how to follow that type of talk. So giving them too much credit there. I'm just throwing a protective order in just in case, while some there's just news. I don't want to have to market order out when there's some crazy type of news, so I'll just keep that there. Just always trying to stay protected in case something happens and I can't react or press the button fast enough. What I'm not liking on these positions right now is if you're reading the tapes when it goes through, not only for this, but I'm also watching the tape on ES, like you're getting significantly more pressure to the downside and it's kind of just getting let up, and then you're getting this kind of flow back in to push it higher, and then heavy volume to keep it down. So that's what I'm worried about with my position currently. Like it's just a bunch of these one lots that are going through, one lots, 6 lots, 7 lots, and then you get this like that little like burst down little 20 lot that comes in, and then it'll come up a little bit with one lot, one lights, one lots, and then you just get another 10 that just popped in. So yeah, so the position feels like there's definitely significantly more downside pressure currently. We'll see. It's still in an uptrend. Oh, shitty is that that's exactly where that line is at. We'll see how well it holds. Man. That's fine. It's only 12 down. So that was the run spot. That sucks. So what I'll be doing is I'll only be looking for long setups over the line, and if it breaks that, then obviously you get this breakdown right here. Then I'll be looking to play down to this area, and then look for potential bounces to regain the area as well. All right, so what I'm going to do while I am setting everything up, I am going to go over some of the things that we are doing and we're going to be working on next week in terms of it's going to be the 0 to 4 day DTE strategies, days till expiration. And then the things that you can just put on in the morning, let them play out, and kind of hopefully work with your schedule a little bit. Some of the downsides of this is if you define things too close or too far, things can move faster against you. But most of the time, these are non-directional plays, meaning you don't care which direction they go. And that's why we like to set them up at the bell, let them roll, let it pick a side, and let the market run. So like today, let's pull up SPY real quick. So we're like today we opened at 33.7. So some of the things you can do that we'll be teaching about is running these straddle strangles, nothing naked obviously when it comes to that. So it's then everything from there, all the different types of strategies you hear, the iron condors, the iron butterflies, everything else like that is derived from those themselves, and it's just capping it and defining your speed, play, exposure, and how you want to move about. So one of the things that I always do is a iron butterfly or iron condor to start the day, and I believe today was sitting at, let's check out the expiration. So even today, so even as it's going on, there's still a $2 expected move in the options market for SPY today. Okay, well, $1.79. So let's just say that's where we're at right now. Now premium's going to be almost gone since it's a 0 day. And what you would do is just take the 339 plus 2 on there, 339 minus 2 on there, and you can sell outside those ranges. Okay, and so what you'll do when you want to sell outside those ranges, so on a 341, you collect 29 cents off of that. On a 337, you'd collect 15 cents off that, and you'd run that. And so that would be your strangle. And then if you wanted to cap it to make sure you don't lose that money, that's when you'd be buying out something further. And each strike that you add further out obviously makes you more money for the protection. And the closer it is, the less money you'll be making. But each dollar that you do is $100 added onto the risk that you're going to be taking. So if I wanted to take a 337 for my downside, collect the 16 off that, but I wanted to make sure I collect that because I know it's not going to make that move, I could do a 333 and put 3 cents on there. So that way I'm collecting about 13 cents off of that move. So 13 cents, $13. Then you move to the opposite side. Now, but what I'm doing with that is I'm risking $400 for that side. And this is why you do it in the morning while premium is still inflated. You're risking the, well, 400 minus 13. So you're down to 387 off that you're risking to make that. But the chances of you making that is at such a high probability because of the implied move and the options volatility that's priced into that. So that's kind of what we'll be going into in detail. Let me see if I can pull up something real quick. Yeah, let's do that. Yeah, let's drop it down to 14 and move that over here. So this is what I'm talking about when it comes to, so if I wanted to sell this right here, the 341, obviously it's going up. I could sell that for 30 cents saying it's not going to hit there today. I could sell the 337 at 14. It's not going to hit there today. So that together, those two, I make about, we'll just put it at $50. So $50 on there if you strangled that at that price. All right, and then adding the caps turns it into an iron condor. If you wanted the iron butterfly currently at what it's at, you'd be selling the 339s, you'd be selling the 50s together. You'd be, let's just put it at 200 to make it easy for the math. And then you add your wings. All right, so you wanted one side to expire worthless while the other one obviously is going up. Cap it off for a little bit of protection. So I mean, let's put it at, so $2 there, you probably wanted at $3, so you'd be buying the 349, or excuse me, 342 for protection off that, because it's wide. It'll allow the decay to happen, and you already need this to move up to what is it, 340, excuse me, 340.50 off that, in order just to not make money on that. But if it does go above that, that's when you start losing money on that end, but you're collecting money off of this side. And that's how those plays would work when you're selling. You could also be buying if you're expecting a bunch of volatility. So we'll be diving into that on Wednesday. Wednesdays where we're going to be tackling that. Let's get that off the screen now. And we'll be going over that for the next couple of months until ER season comes back again. The bread and butter of basically this scalping type of stuff preps you for that ER season and makes you think creatively when it comes to putting on these complex option strategies that are going to make you money with high probability. It's not the unlimited YOLO side of making money, it's the calculated math side of making money. So there's that. It's Wednesday, we'll dive into that. And then on Sundays, sorry, I just had to think it all through my head. On Sundays, we'll be going over the 4 DT strategies. So 4 days till expiration, where you could be playing these super wide iron condors. The premium is inflated because it's just the beginning of the week, and you don't need it to hit 100%. You can just collect what you want off of that. So you can make it as wide as you want to collect off that, and you get to Wednesday and you're like, I'm good with the profit. You take it off, and you move forward from there. So there's just a lot of different ways. We'll go over everything, and we'll go over the basic structure of all these plays, when to put them on, what you're looking for when you put them on, these strikes and everything. So I think it's going to be good stuff. I think it'll be a lot of people have been enjoying it in the past. So in terms of using OI, in what you have here, you have volume on the day is going to be 11,000 and 3,000, or let's just put out 4,000 for easiness. You're going to look at the end of the day and see how much of this 11,000 gets transferred over. So you have to wait till the next day for it to pop up. If this is a high position, it's going to force the hand of makers to then reposition themselves out of this. So getting long on a longer dated call here, maybe a 16, even have a higher volume on the, the 160s. So getting long on something here, maybe even putting on a 160, 170, you'll be looking at about a $15 difference there. I think it's worth it. And you know what? I'm gonna probably put it on here in a second. Let's see. Or maybe we can come up with something where we could play both ways. We'll see. Actually, I'm going to wait a little bit here, and I'm going to see if this bounce spot possibly happens, and then we'll dive into the target trade. Okay, so maybe here, I think it's gonna hold off a little bit, and it didn't reach that target where I wanted it to. I probably should have took a position there at the bottom, which I kind of give that couple point leeway, which would be about a $5 loss on that, and I would have got a nice bounce, but that's fine. So here's the target trade that I'm trying to put together for this. So we have the 11,000 that's being targeted at the 150 because of the morning move that happened, and everybody piled into that. So you can either assume that half of them are staying, a quarter of them are staying. You can look to a longer dated position, maybe the Octobers, and playing off that 160. You can go for a culvert on this, and then simply just shed it. So what you'd be doing is let's play, you play OI, open interest, and you take this 160, you're sitting at a 19 delta, and you sell the 170s at a 6. So 19 minus 6 is 13. Funny. Okay, so anyway, so that's what you'll be doing. Well, give me a second. So anyway, so what I was thinking about is, so this is a September 18th expiration, and you have these wide little ranges, and because it goes 1 2 1 2 1 2, and then it picks up to the 150 1 2 or 152s. Is maybe just doing a simple butterfly on this. So you're going to be buying the 150, selling 2 of these, makes you at a $20 net, and then you put it there. It's going to be about like 50. No, it should be about 30 something that you're putting on for that, and you're just looking for the move to happen. It's going to retrace about 50% of that downtrend there within the week, all right? And then it gives you time to get out. So if this makes if the candle on the daily is ugly currently, but we still have 3 hours left in the day for this to retrace. So let's just look into that. So if I want to put this on, and I'm going to just do buy, sell, buy. Let's review that. Send it up. All right, so you're sitting at a butterfly for the 150, 152.5, 155. It allows for a bigger move to the upside. Here, let me get a risk profile up so you can make it just easier. Okay. So you make money as long as it stalls above 150, so a little bit of a breakout, and it stalls before it makes all-time highs. Well, not necessarily, a little bit before all-time highs. And then you make 200 if it does that. So it's a nice payoff. It's risky, short-term, and has to make a move. Okay. But it broke out today. Now it's either going to just completely pull back, and that's what you have to play. And so I'm trying to determine if a short-term butterfly is going to be the best option, or simply just working a longer dated call vert and shutting that off. Another one I'm looking at is Merck & Company. So on the hourly, it has kind of a similar setup to what the daily is for Target, but a little bit more compact, and it's holding this 200-day on the hourly. And so if healthcare gets a bump at all, which, I mean, any vaccine news that comes out is going to be targeting that, that's where I want to play. I think what I was looking at was, let's pull that up real quick, is going to be... Yeah, so it's basically looking at an 85 call for this week. If you're going to play short term, maybe. If you need to play longer, I'm probably looking at like a wide iron condor and just saying, all right, show me your best breakout, and going from there. So maybe like tossing on an 87, 89 for upside call credit vert spread, and then, you know, I'd probably take a 82 and then 80 down. Allows for a retrace of the 200-day, you know, and then we could roll that up and check the activity. It's still very call heavy for Merck. Doesn't necessarily mean shit, so I'm just throwing that out there. So if you ran into, let's just do this week, because that's what you'd want to collect off of anyway. Yeah, so actually what you could do right now is just sell an iron fly on this, and just since it's trading at 84.50, I'd be selling an 85, then selling an 85p. You'd be collecting 105 off that, keep the wings just as wide as we were talking about. So buying a 82, and then buying the, let's give it a little leeway to, give it a little leeway to 88. And so you're collecting, it's going to be a 135 credit, which should be a little bit of downside. Let's see, let's pull this up. So a downside of 164 for a possible upside, if you nailed it right or appropriately, is going to be 135. It gives you pretty okay range at, you know, allows for a $1 drop on the downside, and then allows for a significant pop to the upside. You know, if you wanted to go an unbalanced route on this too, and just be bullish on it or bearish on it, you can close up the ends as well, meaning that you can just make them tighter to one side, and it gives you a little leeway. So if I wanted more protection to the downside, and I was selling buying an 82 for protection, I could pull that back up to an 83, and then keep it to the wide there. And so now I minimize my downside loss to only 64 instead of that 164, And then I just have upside exposure. And what you'll be doing with that is, it's actually not a bad play if you're playing a bullish perspective on it. And so even if you had that play designed, and if you grabbed an 85, let's say, because that's at the money, what it's doing, so you need an 85.50 to get your money back. All right, and then even then it's at probably about 50 delta, 60 delta. If it's still playing within the implied move of that time, what you're doing is, it's just not going to be pretty. You're not going to get the same money from collecting on that both sides as well. So it's another way to collect more money. because I don't want to be streaming all day on this, you know, like obviously the little nerve-wracking side of making sure you always hit the trade. So I'm going to cut it at 2 hours, which is going to be in the next, what do we have, 6 minutes, and we'll go from there. But I think I'm gonna take a trade on target. I'm gonna look at it. We do have a bunch of Fed Powell speech, which is gonna cause a little bit of stalling, so I might adjust it or make it a bit wider. But I think playing a bullish perspective on it seems good because the whole sector seems pretty solid in general. My thing is I don't want it to get blown out of the water to the upside, so I'm trying to figure out a decent way to play that midterm. So we'll see what we have. I might do some type of call condor on that. I might do just stick to a butterfly for a little bit of thing and try to look to take that off on a Wednesday. Maybe if it's that, maybe stop it at you know, maybe whatever percentage I want to target. But I do want to get positive before I get off this stream. I always feel like shit when I take like 2 trades all day and it's just like nothing. But you know, there's a lot of shit that's going around me where life happens. I'm handling other ventures while they're happening. So so let's deal with that and try to get positive here before we end the stream. So a little bit under. Probably any hard push that's going to be under 370. I'm gonna make an attempt for it, just for a fast reaction. It's gonna recover the entire move since breakout, which is a dangerous play regardless. But even if it results in like maybe a point or two taking that off, I want to take that trade. That's something I want.
The dreams. The dreams.
I remember my dreams.
I don't feel comfortable taking this position right here because I want to see that breakdown. If it gave that up, I don't find the pre-market to be that stable enough as a support, which I think that if it is, it's going to take that morning range that it was in and play off a just complete retrace from that. So maybe get a better drawing on this just so I can accurately do it.
The dreams.
So, looking at maybe a hard push under 370 into that range and do that. ESPN deal could add up to material dollars for DraftKings. Sure, GM. Sure. Like, if DraftKings is going to be sensitive about every sport that stops for their business model can't handle even slight bit downside. Do I want to play for a 1.5? Something right here. I don't want to. I'm sticking to my plan. Picking up right after anything that hard push under 70. I think I'm glad that I gave Target a little bit more room to work with here. I didn't want to jump right in, but I'm telling you, man, that breakout it's right off highs, and it's been going down since earnings, right? A month long of going down, and just not at a fast pace either. So to me, that tells me people want to stay in, people want this to work. So, I think it's something you gotta consider. Don't know how I want to play that. I don't want that position to get blown through. So I think what I'm actually going to do is just put on the butterfly, and if it starts going against me with whatever retracement back, I think I'm going to be fine and just kind of take it off a bit. Spread is pretty fucking wide, unfortunately, at a 25, 31, 38. Let's see if we can mid-mark that. I doubt it. I doubt it. I doubt they're gonna let me mid-mark that. It's too wide to let me do that. So, problem is you got a huge 500% like payout if it actually hits too as well. Sorry, 1 second. Oh, that sucks. Fuck you. Let's see. Yeah. Enough that support, that's fine. You know what, let's go, let's not mid-market, let's go up above, let's kind of walk it up a bit, see how it reacts. It's not taking it, and you can see, try to see if anybody's playing any games with you as well. And trying to, you know, work you out of a few more extra dollars to get into this play. Let's see if you can get in at 34, essentially. They're not gonna even let me get. Not even gonna let me get that mid halfway. Ain't that about a something? Ain't that about a something? It is a really nice day outside. Even out there. Alright, so we have one last walk up, and then we're gonna play because the spread is tightening, which means Ivy is increasing on this a little bit and playing to it instead of keeping it super wide. I'm gonna go for 35 on that. And I get you, got walked up again, didn't it? Yep, fucking did. I'm telling you, they fucking play games with you. Son of a bitch, what's the spread? Alright, yeah, so the spread went down from a 31 to 37 on it, and I was bidding at 35. It's opening up to a 32, 34, or 40 now, so that's just a poopy. You know what, we're gonna leave it at a 35 though, for right now. Let's see if we can get in a position end of day, because I'm still gonna play bullish. So with the market looking to test this area again, so I'm going to lower my bid a little bit so I'm not just getting utterly destroyed if it wants to pull back. So I'm going to drop it by a little and try to keep my focus on this while doing that at the same time. Like I want this push that's going to be down here. It's going to be right at that mark, so if I can get it, they're going to hold 170, aren't they? We did below it. No, we haven't dipped below it yet. Okay. It's fine. I want the reaction off that. Let me see if I get filled. No fill. fill yet on the target trade. I do think whatever reaction comes out, 170 is going to be a prime, or 3. I keep saying 170. 3370 is going to be a reaction off of that 3-point rise off of it. Somebody's going to hold it right up and then make their attempt to push it back down again. But this is why I want that level, because they opened up right there. That's where all the volume came in at. How significantly down lower are we from the WAP area? Shit. Okay, so we have a slight bit of a problem. My son needs a little insulin. I have alerts set, so I'm going to be sprinting back to my desk the second I hear my alert go off. It's going to be fun. It's going to be fun. So if it drops below that 3370 range, I'm going to try to get here as fast as I can. Try to get on a trade. I don't want open exposure, because if it dips below that low of day, that's going to be a painful trade. And I have no control over it either, so no to that. Alright. right, so I got filled on the target trade while I was away. I got filled at 35 on a 150, 152, 155. It's a bullish upside on that, and if it comes back and retraces during the week, who knows what it does. We'll try to do that, but at least with that, it'll give me, with a call condor, I'd get a little bit more room in case it does retrace and not as fast. So we'll have to just play that the way it is and see how it goes. I really want to stay on until I can get green on this damn trade, but we'll see if it can get, what, 34 off of this, 34.5. Should be good, maybe reverse. So let's get in. Let's see what happens. There we go. All right, I got a better trade off that, so let's roll with that. That's where I'm going to end the stream for right now. We'll be back on for an hour later, and we'll try to go through everything, and we'll discuss some of the plays, maybe do a little bit of extra things. And the little guy wants to say hello. You want to talk into the mic? No. Okay, that's your word for the day. All right, I will see everyone tonight, probably around 8 or so.